It's Brian Preston, the Money Guy.
So how does this play out in the real world? And before we talk about a strategy, like a real life actual strategy you could be employing, it's important to have some context. You guys have seen this chart before, but what this chart lays out for you is all of the bear markets and all the bull markets from 1942 all the way through this year. The length of the market shows how long it lasted, and then the depth or the height of it shows how severe it was. So what you can see here is that more often than not, bull markets are substantially more severe in a positive way than bear markets.
Severe sounds so negative.
I know, but I'm trying to
bull
think.
markets are awesome.
They're awesome, more awesome than bear market. But see, that's just kind of a given, more awesome than bear markets. The gravity through which you experience a bull market way outpaces the gravity which you experience in a bear market, and they tend to last for a lot longer of a period of time. So even when you're going through periods of volatility like this, it's important to remember that. It's important to keep that archive in the back of your mind.
Well, that's why here's the optimist take of this. And Bo's already thrown out one of my slides, but this is a way for me to put it back in for Daniel's benefit too, is that we know that fortunately bull markets last much longer and happen more frequently than bear markets. So I think that this puts a priority on the fact that when we do have that 2 out of 10 years, you ought to be like a squirrel who's harvesting and putting a bunch of nuts to save for the winter, because there will be really good gains in the future. So the harder you work while things are cold outside, and you're harvesting, and just say that you will see that the benefit for this for many years in the future. You are filling up that silo of losses. That's one of the things I'm telling you, me personally, I'm talking about my personal portfolio, plus what we do for all of our clients. I've done this at least twice this year because I take it very serious, and we're going to have an example of how that boom bust cycle works. This is not a set it and forget it one and done. This is something that you actually can use this strategy throughout the volatility of the market, so that as we come through this short-lived bear market, you will be able to hit the ground running and really have a really strong tax strategy for when things are good too.
But you got to be a financial mutant. You have to recognize that these opportunities don't happen all the time. You can see in the chart that we just showed that bear markets don't happen all that frequently, despite what the financial media might suggest to you. So when we have these large drawdowns, like what we're seeing this year, it makes a lot of sense to capitalize on them. It makes a lot of sense to be able to take advantage of them. So let's do a real world live case study based on something that could have happened this year, in the year 2022. So let's say that Jasmine has $100,000 invested in an S&P 500 index ETF on January 1st of 2022. Let's also assume this holding is held inside of her taxable brokerage account. She decides that, man, this year has been volatile and I'm going to take advantage of loss harvesting. So every time my holding drops by $10,000, I'm going to go harvest those losses. And if you look from January through September, that occurred in February, and then it occurred again in June. So here's the practical nature of what Jasmine did. On February 23rd, she sells her S&P 500 ETF to harvest a little over $11,000 of losses. She then takes the proceeds from that sell and immediately buys a total market index ETF so as not to violate the wash sale rules. They are similar but not identical. Well, then, if you remember, she starts feeling pretty good. Second quarter started off pretty nice. She's thinking, oh, wow, this worked. I lost harvest and market started making money. And then the shoe dropped. And then it happened again. And then the market in the second quarter continued to drop. And so then she decides, you know what? On June 13th, I have crossed over that $10,000 loss mark again. So now, on June 13th, what I'm going to do is I'm going to sell my total market index. I'm going to harvest another $10,600 of losses. And because it's been 30 days since I last did that transaction, I'm going to buy back into the S&P 500 index fund now. So I own the S&P. I got out of it. I rode in the total market. It lost money too. I harvested that loss. Now I got back in the S&P 500.
Well, I think that's interesting, Bo. If you could just bring up the visual again, a lot of people, the naysayers or the I'll just call them the trolls under the bridge that are going to come out in the comment section, they'll say, guys, why'd you do all these trades? Why wouldn't you just wait until June and just buy them? Well, you do this loss harvesting one time in June when it was at the lowest. And it's exactly what you shared. And that's why I feel like I'm just giving the commentary of answering the unspoken part, is that we never know when markets are going to recover. If you think about like the pandemic of what happened in 2020, the market got crushed, went down that 35%, but then shot off like a rocket. We harvested losses in that downturn, but then we hit recovery mode so fast that if you were trying to wait for the second or even the third, so you reach the dead bottom, you might have missed it.
That's right.
So we don't remember. None of us have the crystal ball of knowing what's going on and when the full recovery, because there might be some false positives or false recoveries that occur in any bear market. Even in 2008, if you remember, after the election season of 2008, the market actually closed up at the end of the year, not for the year. It was still down 37%, but it was at a low of over 50% down, but then it closed down 37% because it did have a 10 to 15% recovery right after the election cycle before we went right back down to and tested the bottoms of January through March of 2009. It's not uncommon to have those fits and starts where things look like they're getting better. That's why you might do this multiple times in a year, is because you think you're at a bottom, you harvest losses, we have a temporary recovery, then we fall even lower, you harvest again. I know it's creating work for you, but it shows up and it does create value over the long term. Pay attention to these cycles.
And so where is Jasmine net? So through October 12th of this year, she's harvested $21,700 in losses. Now, what those losses can do is they can offset capital gains this year. If she offsets all of her capital gains, they can offset $3,000 of ordinary income, and anything left over can move into future years. And in those future years, it can offset capital gains, or it can offset up to $3,000 of capital losses. Of ordinary income. A lot of people don't realize, well, I don't want to harvest any more loss. I've harvested plenty. Remember, bull markets last for a long time, and you can have a down year where, man, it feels painful, but the next year's pretty good and you can use those losses. And the next year's pretty good and you can use those losses. It's not uncommon to be able to harvest losses in 1 year that can offset triggered gains for the next number of years. You're basically getting to invest your portfolio tax-free, which is a super, super awesome thing to be able to do.
Well, it's not uncommon. Look, I'm going to talk in reality here from a financial planner, is that for 7-figure portfolios, it's going to be a 6-figure loss that you've harvested. And you're like, well, why would, 3,000 is all I can offset. Are we really going to take $100,000, $200,000 of losses that we're just going to carry forward? Yes.
Yeah, absolutely.
Because there will be some years in the future where you're going to have distributions at year end, or you have some big transaction yourself. You're going to be so thankful that you had the losses to offset those gains. So you got to essentially experience the recovery without having to pay the taxes on all those distributions,